On a cold morning in November 2008, a bank in London executed 4,732 transactions in under 9 minutes, and no one noticed until the money was already gone. The transfers were clean, no alarms, no masked intruders, no smashed glass, just numbers sliding silently across servers from London to Dubai, from Dubai to São Paulo, from São Paulo to accounts that didn't officially exist. By the time compliance officers realized something was wrong, £11.4 million had dissolved into a lattice of shell companies spread across 12 jurisdictions. What investigators didn't know then was that this wasn't theft in the traditional sense. It was a proof of concept. The architect behind it wasn't hiding in a basement or laundering money through nightclubs. He was studying international finance law, specifically the microscopic inconsistencies between national regulatory systems. Born in the late 1970s in a mid-sized European port city, he grew up around shipping manifests and customs paperwork. His father worked logistics. His mother translated contracts for maritime insurers. Dinner table conversation revolved around tariffs, sanctions, and the art of moving goods across borders without friction. He learned early that every country enforces rules differently, and more importantly, that no country enforces another country's rules. At university, he became obsessed with something most students ignored: settlement lag time. The 24 to 72-hour window where international transfers technically exist in multiple places at once before clearing. A financial limbo, a space where money is both sent and not yet received. He noticed something buried in regulatory language between EU banking directives and offshore financial havens: discrepancies in reporting thresholds. Transactions under certain limits triggered no automatic scrutiny. Different limits in different countries. Different compliance triggers. He didn't need to hack a bank. He needed to choreograph one. The first breakthrough wasn't dramatic. It was mathematical. By splitting large sums into thousands of sub-threshold transfers routed through layered accounts, each governed by different regulatory ceilings, he could move capital across continents faster than oversight systems could synchronize. Banks were secure. Governments were not aligned. That was the flaw. Within 6 months of the London incident, similar microbleed events appeared in Singapore and Toronto. Individually, each case looked like internal processing errors. Collectively, they formed a pattern, but only if you zoomed out across borders. And no one was looking across borders. Why would they? Financial crime units were national. Prosecutors were territorial. Intelligence agencies focused on terrorism and espionage. The idea that someone was exploiting regulatory fragmentation itself hadn't occurred to them. He wasn't stealing vault cash. He was exploiting jurisdictional physics. By 2010, he had built a network of over 3,200 shell entities across 19 countries, none of them illegal on paper. Each one registered within the compliance limits of its host nation. Every government saw a piece of him. No government saw the whole. How do you arrest someone whose operation technically complies with the letter of each local law? And if no single country can claim total jurisdiction, who gets to prosecute? The transfers grew bolder. Tens of millions moved in carefully timed bursts during market volatility, moments when compliance departments were overwhelmed. He began manipulating not just lag time, but currency conversion discrepancies. Rounding differences alone generated millions in skimmed arbitrage. He wasn't siphoning money directly from banks anymore. He was bending the seams between them. Whispers started inside the European Central Bank. The Financial Action Task Force flagged anomalies but lacked authority to act. Interpol received fragmented reports. Canada saw one cluster, Germany another, the UAE something else entirely, but none of the reports named the same suspect. He used layered digital identities registered under legitimate business consultancy fronts. He traveled constantly. Malta one week, Hong Kong the next, Panama after that, always in countries that lacked extradition treaties with whichever government had the strongest case at the time. It wasn't evasion, it was choreography. In 2011, a senior compliance officer in Zurich finally connected 2 transaction trees that mirrored each other across continents. The pattern was unmistakable: synchronized fragmentation. For the first time, someone realized this wasn't error, it was design. A quiet internal memo circulated across European regulators with a single line underlined: subject appears to be exploiting regulatory misalignment across sovereign banking systems. They didn't yet know his name, but they knew this wasn't going to stay contained, because the next transfers weren't in the millions, they were in the hundreds of millions. By 2012, the numbers stopped looking like anomalies and started looking like strategy. 280 million euros moved through Baltic clearinghouses in a single quarter. $410 million passed through layered accounts in in Hong Kong during a 36-hour currency swing. A cluster of synchronized transfers hit banks in Cyprus, Luxembourg, and the Cayman Islands within the same 5-minute window, timed precisely during a regulatory holiday overlap. It wasn't theft in the conventional sense. Every transaction had documentation. Every entity existed on paper. Every compliance box was technically checked. But the capital didn't belong to the shell network moving it. The pattern had matured. He had evolved from exploiting reporting thresholds to weaponizing regulatory timing. When one jurisdiction froze an account pending review, another jurisdiction's transfer window had already closed. Funds moved faster than subpoenas. National financial crime units began comparing notes. The UK's Serious Fraud Office opened a cross-border inquiry. Germany's BaFin flagged recurring transaction clusters. Canada's FinTrack noticed unusual routing redundancies. Singapore's Monetary Authority quietly escalated concerns to Interpol. Interpol issued a coordination alert, not a red notice, not yet, but a multilateral advisory flagging what they described as a systemic exploitation of asynchronous financial regulation. Still, there was a problem. No single country could demonstrate full criminal intent within its borders. In Malta, the consultancy firms were registered legally. In Panama, the holding companies complied with corporate transparency rules. In Hong Kong, the transactions fell within permissible thresholds. The architecture was clean. The damage was cumulative. By late 2013, conservative estimates suggested $1.2 billion had passed through the network. Investigators believed a fraction, roughly 8 to 12%, was being skimmed through arbitrage manipulations and conversion rounding discrepancies. The rest, routed, repackaged, reinvested. But into what? Was he enriching himself or building leverage? That question began to trouble intelligence agencies because some transfers weren't random. They coincided with sovereign debt turbulence, with election cycles, with commodity market volatility. When a mid-sized Eastern European nation experienced a sudden liquidity squeeze during a bond issuance window, regulators noticed something disturbing. A synchronized withdrawal pattern mirrored the shell network's signature timing. Was he merely exploiting volatility, or was he creating it? In Washington, the Treasury Department's Office of Foreign Assets Control quietly joined the analysis. The FBI's Financial Crimes Unit opened a file, not for fraud, but for potential market manipulation across jurisdictions. The CIA monitored communications tied to offshore intermediaries. Meanwhile, he adapted. He shifted from banks to payment processors, from payment processors to fintech startups operating in regulatory gray zones. He began acquiring minority stakes in small clearing platforms in Africa and Southeast Asia, regions with emerging oversight infrastructure. He wasn't just moving money anymore. He was embedding inside the pipes. By 2014, authorities from 9 countries formed a joint task group, not publicly announced, not politically advertised, a silent coalition of regulators, prosecutors, and intelligence analysts. For the first time, they pooled transaction data in real time, and that's when they saw it, a central orchestration node. Not a single server, not a headquarters, but a pattern of synchronized IP initiations rotating through virtual private infrastructures in countries with strict data protection laws. They identified 3 core digital identities believed to belong to the same operator, but none could be tied conclusively to a physical person. Extradition requests were drafted, then stalled. Jurisdictional disputes emerged. Which country had suffered primary harm? Who could claim prosecutorial authority? While governments debated, he expanded. A former associate in Luxembourg began cooperating quietly with authorities, not out of morality, but after discovering that certain shell companies were being dissolved without his knowledge. Funds redirected, equity diluted. Had the network grown too complex even for its creator? Or had he begun eliminating internal risk? Investigators learned of encrypted communication channels routed through diplomatic data corridors. They uncovered indirect ties to legal firms specializing in sovereign immunity frameworks. That changed everything, because sovereign immunity isn't a financial instrument, it's a political shield. Was he aligning with state actors? Was he positioning himself as an untouchable intermediary? Or was he preparing an exit strategy no government could block? In 2015, $670 million moved through the network in a single coordinated event spanning 14 countries. The task group moved to issue an international arrest framework. But before the paperwork cleared, he disappeared. No flight records, no border alerts triggered, 3 passports flagged, all expired, digital identities dormant. The money trails continued for 6 more weeks, then stopped. The system he built was still moving, but the architect was gone. The first confirmed sighting came from an airport lounge in Buenos Aires. A private security contractor flagged a man matching one of the composite profiles, traveling under diplomatic credentials issued by a small island nation with limited international visibility. The passport was valid. The clearance codes checked out. The issuing country had recently signed bilateral infrastructure agreements with multiple emerging markets. But something didn't align. Interpol cross-referenced the biometric scan with archived visa data from Malta, Cyprus, and Hong Kong. The facial structure matched within 87% probability, just below prosecutable certainty. He wasn't hiding, he was shielded. The island nation denied wrongdoing. They insisted the passport holder was an economic envoy, advising on financial modernization frameworks. Extradition requests were drafted anyway. They were rejected within 48 hours. Sovereign immunity. The task group escalated. The United States invoked financial sanctions authority. The European Union applied asset freezes tied to shell entities believed connected to the network. Singapore revoked operating licenses of 2 fintech clearing platforms suspected of facilitating residual transfers. Yet no direct arrest warrant could stick. Why? Because the majority of what he had done, fragmented transfers, regulatory arbitrage, conversion skimming, exploited gaps rather than violated explicit statutes at the time. He had operated in the silence between laws. And now that silence was closing. In early 2016, a breakthrough came from an unexpected angle. Not financial, not digital, political. A parliamentary oversight committee in one European country discovered that its sovereign wealth fund had unknowingly partnered with one of his shell conglomerates during a joint infrastructure financing deal 2 years earlier. The network hadn't just moved capital, it had embedded into public investment vehicles. The scandal detonated. Suddenly, this wasn't about technical compliance. It was about national exposure, about the possibility that state funds had been indirectly leveraged through an opaque architecture no single government could trace end to end. Pressure intensified. Interpol upgraded its advisory to a red notice. The FBI publicly acknowledged an ongoing international financial manipulation investigation. The Financial Action Task Force proposed emergency harmonization standards targeting asynchronous settlement windows, but the subject remained unreachable until something unexpected happened. He made contact. Through legal counsel in The Hague, he proposed a structured negotiation, not surrender, negotiation. In exchange for limited immunity from retroactive prosecution, he offered to provide a comprehensive technical briefing on the vulnerabilities he had exploited, a blueprint of systemic weaknesses, a roadmap for regulatory alignment. Governments hesitated. Arresting him would satisfy headlines. Listening to him might prevent the next one. Closed-door sessions followed. Representatives from the ECB, U.S. Treasury, Interpol, and multiple national regulators attended. For the first time, the architect walked through the choreography step by step, the settlement lag windows, the cross-border reporting discrepancies, the jurisdictional blind spots. He didn't deny what he had done. He reframed it. "You built isolated systems," he reportedly said. "I simply proved they weren't synchronized." Within 2 years, international banking standards changed. Reporting thresholds were harmonized across major financial hubs. Real-time cross-border data sharing agreements were implemented. Settlement lag times were reduced through coordinated clearing reforms. Shell company transparency regulations tightened. The architecture he exploited began to disappear. As for him, no public trial ever occurred. The island nation quietly revoked his diplomatic status amid mounting pressure. He resurfaced as an advisor to emerging fintech consortiums focused on compliance technology, ironically, helping build the safeguards designed to prevent his own methods. Was it justice? Or was it adaptation? Some investigators believe billions remain unaccounted for, capital that moved through the lattice during its most opaque years. Others argue the true value wasn't the money skimmed, but the leverage demonstrated, that in a globalized financial order, fragmentation is vulnerability. He was never caught in the cinematic sense. No handcuffs, no perp walk. Instead, the system recalibrated around him. Today, international enforcement agencies coordinate through shared data frameworks that didn't exist before 2016. Cross-border financial crime units operate in real time. Settlement windows have narrowed to minutes, not days. But new technologies are emerging. Decentralized finance platforms, sovereign digital currencies, autonomous clearing systems. New seams are forming, and somewhere, someone is studying them. Because the lesson wasn't about one man. It was about a world stitched together imperfectly, and how power flows through the gaps.